Hey everybody, today we are going to talk about derivative market. Specifically, we will talk about options. Okay, the options can be of two types. One can be a call option, and second can be a put option. Now in most cases, this kind of a jargon, what does this really mean? So if we take the conventional definition, call option is a contract between two contracting parties where they agree to sell the underlying asset at a predefined value, and this contract is exchanged at a premium, and this has to be executed within a pre-decided time frame, else it is not valid. Now this is very complicated for a common man to understand. I have a simple mind and I need some practical, simple definitions. So for that, we are going to break this down to a very, very simple level where anybody can understand what this means. Okay, so let us take Mr. A or person A, and I'm drawing a stick figure. I like drawing stick figures, and let's name this person as A. Okay, now person A has $1,000. Now let us say person A wants to get really rich. So person A decides to buy something which person A thinks they can sell later for a much higher price. So person A, let us say, buys 100 quantity of a stock. Okay, let us say Apple stock. Okay, for this example, let us say this 100 quantity of the stock was for $10 each. So person A basically spends $1,000 buying the stock. Now we are assuming no commission, so it's easier to explain and understand the example. Right, so this is dollars and this is total dollars, and now this person A has 100 stocks. Now let us say this person intends to hold this for another 1 year, where let us say this $1,000 becomes $1,200, and this person A is going to make profit. That is what person A wants. I mean, of course, this, instead of becoming $1,200, it can also become $900, and person A can end up making a loss. So I hope this is clear so far. Again, this assumes that you have basic understanding of basic trading and buying and selling of stocks in the stock market. Also, just note that instead of this 100 quantity of stock, it could also have been a commodity or some kind of a commodity derivative. So to basically make things simple, what you see in that complicated definition earlier, we said underlying asset. Those are just fancy words for, let's say, stock in this example, or a commodity which you see over here, right? So I hope everybody is on the same page. So far so good. If not, go back and rewind the video and watch it again. Alright? So, let me draw a line here so this is not super confusing. Okay. Alright, now let us say person A is restless within this 1 year, where person A has to wait for this becoming $1,200. Okay? And person A thinks that it will probably go till $1,200 in this 1 year, but it is not going to go beyond it. So person A thinks, okay, I mean, that is all I want to make, and if at all, let's say instead of 1,200, this is indeed going to go ahead and become, let's say 1,500, person A sees that as a very low possibility. Okay, low however, of course, there can be many other people in market who can see this still happening within 1 year. They have tremendous trust on whatever the stock is, right? And they think that this can go way above 1,200 and it can happen. Now, let us introduce another stick figure. I really like drawing stick figures. Let's say this is Miss B or person B. Now, person B in today's world, let us say, only has $250. Okay, person B has only $250. So, now, and excuse the camera angle, I'm doing this for the first time, so I might be making some mistakes. Bear with me, guys. I'll try to improvise in my next videos. Okay. Now, person B is the person who really thinks this 1,500 can happen. This can be speculation, this can be educated guess, whatever you call it, right? But person B does not have enough money to buy 100 stocks which will cost person B $1,000. Person B only has $250. Or person B might have $2 million, but he or she only wants to spend $250 right now, regardless, right? So, this is the time which is ideal for a call contract happening. Now, let us see how that would happen. Okay, person A will say, okay, I don't see this going beyond $1,200 within a year. So let us say today is 1st January 2018, and this 1 year which person A is assuming is 1st January 2019. Okay, so person A will say, okay, I'm going to create a call contract and I'm going to sell a call contract. That means I will promise to whoever in the market that I will give them 100 quantity of stocks, right, at the price of $13. if they call upon me within this time frame between 1st January 18 to 1st January 19. I will repeat. Person A says, I will create a contract, which is a call contract, which will be valid between 1st January 18 to 1st January 19. And in that contract, I'll say that I'll promise to give somebody 100 quantity of this stock, which I already have, at the price of $13 per stock. And for this, why should person A do this, right? Because person A already has the stock. Person A will benefit $300 if the price of stock becomes from $10 a stock to $13 a stock anyways. Why should person A do this? So the reason person A does it is because person A thinks that this is not going to go beyond $12 a stock, which is $1,200. So person A would draft this contract, but what is the incentive for the person A to draft this contract? Person A will say, I will, in order to give this contract to somebody, I'll sell this at a premium. At a premium of, let us say, $250. So with this, what person A is promising is that person A will give a stock at rate of 13 within a year if called upon, but in return person A is just asking $250. So that means if the stock price does not go high enough to go to $13, person A is going to keep this $250 which person A has charged, and obviously the person who is buying this contract from person A is not going to ask for this because they can probably buy it cheaper in open market. Now this, what we spoke about, was from the point of view from person A. So this was call, sell. Now let us talk from the point of view from person B. Person B really has high conviction in the stock price going to $1,500, but person B doesn't have money or doesn't want to invest more than $250. So it becomes very easy for person B to say, okay, I'm going to buy this call contract. Call, buy. So person B will buy this call contract just by paying $250, and person B knows that this $250 is down the drain if the contract or if the share price does not go above $13, right? So person B knows that, but person B thinks that this price might go $1,500, that is $15 a share, or $1,600, $16 a share, and so on. Now person B does not have to put all $1,000. Person B would say, okay, I'm just going to put $250 and I have assurance till 1 year that if something happens, I will get these shares sold to me then. So now what happens is person B would buy this contract, which is a call buy against person A. What the person A did was the call sell. Person B does the call buy, and what happens is within this 1 year, I mean it can be even within 1 month or 2 months, the same thing happening if something drastic happens, or just in a natural growth, if it grows, let's say $16 a share within, let's say, 8 months. In that case, person B will say, okay, this contract has grown a lot, so now it is $16 a share today. So it will call upon person A by stating this contract. Say, okay, give me this shares right now, and basically person B will make, let us say the price is $16, so person B will make $3, which is 16 minus 13 is 3, so $3 into 100, so $300 as a profit. But then remember, person B has already paid the $250. So basically person B will, in this case, will make the $50 of net profit. So $300 because 16 minus 13 is 3 into 100 stock. So $300 on gross profit, but $250 was paid in premium. So person B will then make $50 as the net profit. Now, this example does not include any commissions to the broker, so that needs to be considered. There are also some other caveats which can happen in this example, which we'll try to cover in the following videos, etc. So, and basically this is a high-level concept of how a call contract works, right? And rather than the actual definition, I think having stick figures how this transaction happens and what's in it for person A and person B, understanding that gives you a whole picture and overall definition. Now, so that's what I wanted to convey to the audience and my viewers and subscribers. So that's pretty much for this call. I'll try to improvise as we go ahead, make a little bit better handwriting, make a better video. But hope you stick with me. Subscribe, like, and comment. Tell me what you wanna know next, and let's try to foster this community to the next level in next vlogs. That's it for today, guys. Thank you so much for your time, and have a great day, night, evening, wherever you are. All right. Have a good day.